this is a really good question, very appropriate for where we are. How long does implied volatility take to contract? You want to take a stab?
How long? Is it number of days? Is that what we're going with?
By the way, this segment is sponsored by the SIBO. So implied volatility expands and contracts as market uncertainty fluctuates. When implied volatility spikes during periods of high uncertainty, how long on average does it take for it to contract back down? And we're going to put some context around that, but you want to take a guess? Like,
well, is it number of days? That's what I was asking you.
Yeah, it's periods of time. Yes. Here, I'll show you. Let's go to the next slide.
I'm gonna say 3 to 5 days.
So the implied volatility of an instrument is used to estimate the current sentiment of uncertainty around that instrument. It's a measure of fear. And what happens is, what's so cool about measuring fear is that when you think about it, there are very few ways in the world to measure fear. Can you think of another way that we measure fear? That's just a question.
No, I measure fear.
Yeah.
No, not off the top of my head. No.
It's not a trick question. It's a really difficult thing, because in the financial markets,
availability might be one, pricing might be another.
Okay, that's fair.
I don't know.
When you think about this, in the financial markets, we are able to, this is one of the coolest things about finance. We are able to measure fear because there's an active two-sided market. If I look at the VIX futures, they are literally one tick wide. Mm-hmm. We can trade fear and uncertainty around the S&P 500, which really is a measure of, global fear and stuff, and with a tick wide. That is the coolest thing. You can't do that anywhere else. The only other thing I could think of about measuring fear would be the price of insurance in certain places. For example, does flood insurance or does hurricane insurance measure fear effectively? And the answer is, well, it measures fear. I don't know how effective it is. Does car insurance measure fear effectively? Yeah, it does, but it's got a lot of premium built into it. It's not as efficient. You couldn't sell it. You could buy it, but you can't sell it. So it's a one-sided market, right?
Right.
So there's a couple things about fear. The other thing, since we have a tight market on fear, we're also able then to back it out of a Black-Scholes model and figure out what expected move is going to be. So we can give you an accurate theoretical expected move based on a liquid market for fear. Also, fear or volatility mean reverts over time, which results in implied volatility contraction. So looking back through history since 2005, here are the most notable instances of both the lowest and highest recorded volatility. This is since 2005. We've had two situations we got over 80. One was I don't know if it was the end of 2008 or early 2009, but it was right in that period. And then there was obviously 2020 in the pandemic. We got to 82.5 or 82.60. Those are the two times we traded over 80. In 2017, which was a year after kind of a little bit of the wildness of the 2016 election cycle, we just died. The lowest recorded volatility since 2005 was 9.14. Now, I remember back in the days trading on the floor where we had implied volatility that I think one point got as low, not talking about daily, because daily I've seen 3 or 4%. But I think we got monthly implied volatility back in, I don't remember the year, but I think we got it down to like in the 6 or 7 handle, back when implied volatility was measured against the S&P 100, not the S&P 500. Do you remember that?
I do, but
I just don't remember the year.
I don't remember the year either.
Anyway, it's interesting.
We were on the show. We were doing the show. I remember that, but I don't
remember. No. This is way before we even left the floor. This was like in the either 80s or...
Oh, you're talking about that when volatility got down to the 7-8 handle?
Yes. Monthly volatility got down to 7. The daily volatility, weekly volatility always gets down to that level, but not monthly.
Right.
Anyway, the lowest monthly, this is monthly, was 9.14. Deep back into our earliest data, 1990, we see that the VIX has over 30 occurrences with less than 8.5% of the time. So in other words, what we're looking at here, when IV spikes during periods of high uncertainty, how long on average does it take to back down? And so what we did is we looked at the times that it spiked, the percentage of times that it takes to back down, the percentage of times that the implied volatility is in those levels. You can see it right here. 1% of the time over 50, 2.5% of the time over 40, 8.5% of the time over 30, 38% of the time over 20. Where we are right now is 90% of the time over 12, and under 12 is 10% of the time. So what does this mean? This means that if we get up over 50 or 40, you got to sell it, but it's hard. If we get down under 12, you got to be careful about selling it. You're not buying it, but you got to be careful about selling it. And if you're in no man's land where we are right now, ooh, it's tough. So here's the study we put together. From 2000 to present, once the price of the VIX exceeds a certain threshold, how many trading days pass on average before it experiences a 20% correction?
So from 12, you'd be well, here from like 15, you'd be talking about a $3 correction back to 12.
No, a 20% correction. So yeah, in this case, if it was 15, it would go back to 12.
That's what I just said. 3 to 5 days.
That's short.
Yeah, I think so. That's what I'm thinking. I mean, I don't know.
Let's go and take a look.
What do you think? What do you think? Hold on. What do you think?
I already just see it right here. I don't know the answer.
Oh.
I don't know.
Okay.
So the larger the implied volatility, the faster it contracts. When volatility expands, it tends to last roughly 2 to 3 trading cycles. Here are the numbers up here: 40 to 32, 20 to 16, the average number of trading days before a 20% correction. This is very interesting because I would have guessed, like Tony, that it was much shorter than this. I would say from 20 to 16, that makes sense at 85 days. But from 30 to 24, I would have thought it was shorter than 48 days. Basically, what they're saying here, Bat, is it gives you some time.
Yeah, I see that. I mean, I'm just looking at volatility right now. I mean, we just had a spike up in volatility. I don't know, up to 18 as its high, and here we are sitting at 16 right now, and it took 48 hours. I mean, we went from 15 to 18 in 3 days and back down to 16 in 2 days. I don't know, a little weird.
Yeah.
Maybe they're looking at VIX, and VIX trades a little bit differently.
And then on the right-hand side is the percentage of trading days above the threshold, which is very interesting. I'll just leave it there. It's interesting. These numbers are higher than I thought they would be, which gives you a little bit more time. I mean, obviously the 40 to 50 seems out of line compared to the 40 to 32. I think that's just an anomaly because it probably hasn't happened that many times. So the takeaways: when implied volatility expands, it eventually mean reverts and contracts. It takes roughly 2 to 3 45-day cycles for implied volatility to contract 20% on average. The higher the implied volatility, the faster it contracts. That I think we knew. That was nice. Really good study.